If you think your credit score was invented to measure how financially responsible you are, you've fallen for one of the most successful rebrands in human history. The three-digit number controlling your ability to buy a home, rent an apartment, or even get a job didn't start in a boardroom in 1989. It started thousands of years ago as a tool of social control, and the core trick hasn't changed. Every single month, millions of people stress over keeping their score above 700. We treat it like a moral report card. But if you're trying to build wealth in the modern world, playing by the credit score's hidden rules can actually keep you broke. In this video, we're going to strip away the illusion. By the end, you'll understand the ancient origins of debt scoring, how modern algorithms manipulate your behavior, and the exact steps to use the system without letting it use you. Go back 4,000 years to ancient Sumer. People didn't use paper money or credit cards, but they had debt. Local rulers tracked who owed what on clay tablets stored in central temples. Here's the key difference. Those ledgers weren't created to measure if a citizen was trustworthy. They were created so the ruling class could track who owed them labor and grain. It wasn't financial management, it was obligation management. If your name was on the tablet with a high debt burden, your freedom was restricted until the temple got paid. The fundamental principle was established right then: track a citizen's debts centrally, and you control their behavior. But if debt tracking was just about controlling ancient farmers, how did it transform into something we actively beg banks to give us today? Jump forward to the 1800s in America. Mercantile agencies started popping up to help business owners decide who to extend store credit to. Agents walked around towns asking local gossipers about business owners. These early reports didn't just look at money. They rated people on character, church attendance, drinking habits, and racial background. If an agent didn't like your lifestyle, you got a bad rating, and local merchants cut you off. It was explicitly a moral judgment system masked as business risk assessment. The score wasn't measuring your financial health, it was measuring your conformity to society's rules. You might think modern algorithms erased that human bias, but the modern formula actually kept the exact same trap. In 1989, the Fair Isaac Corporation introduced the FICO score to standardize everything. The promise was fairness, no more subjective local gossip, just raw math. But look closely at what the math actually measures. Your score doesn't go up when you save money. It doesn't go up when you invest, build an emergency fund, or increase your net worth. You could have $1 million in cash in the bank, and if you've never borrowed money, your credit score is literally zero. The system isn't measuring your wealth, it's measuring your profitability as a debtor. And here is where the subtle deception turns into a real financial trap for everyday people. To maintain a high credit score, you must remain in active debt. The formula heavily rewards you for having multiple active loans and keeping them open for long periods. If you pay off your mortgage or close an old credit card you no longer need, your score often drops. Think about how absurd that is. You become objectively safer financially by eliminating a debt, but the system penalizes you for it. The algorithm is designed to keep you inside a continuous usage loop. It trains you to treat debt as a natural, permanent part of daily life rather than a high-risk tool. But it gets worse when you look at who actually profits when your score goes up. Banks love a customer with a 780 credit score, but not for the reason you think. They don't love you because you're rich. They love you because you're predictable. A high score tells lenders you will consistently borrow money and pay just enough interest over time to make them rich without defaulting. The moment you stop borrowing altogether, you become useless to the system. The metric you are taught to chase is optimized for lender profit, not your personal independence. So if the system is rigged to keep you borrowing, how do you navigate housing, cars, and life without getting trapped? You don't need to completely abandon the system to protect yourself, but you do need to change your mindset. Treat your credit score like a tool you rent, not your identity. Never carry a balance for the score. Pay your card to zero every month. You do not need to pay interest to build credit. Keep your debt-to-income low in real life. Don't take on higher credit limits or bigger loans just to boost a score metric. Focus on net worth over credit score. Your net worth is what buys true financial freedom. Your credit score only buys more debt. Manage the score strictly as a utility to secure lower rates on essential assets like a primary home, then put your focus right back onto building actual wealth. The credit score isn't a measurement of your character or your financial success. It's the modern version of an ancient ledger designed by lenders, for lenders, to keep you predictable. Once you realize the score measures how good you are at managed borrowing rather than how financially healthy you actually are, the illusion breaks. Use it when you need to, but measure your progress by what you own, not what you owe.